Revenue, costs, and profit are fundamental concepts in business that determine the financial health of a company. Understanding how these elements interact is essential for running a successful business and making informed decisions about pricing, production, and overall strategy. Revenue is the total income earned by a business from its sales of goods or services over a given period. It represents the money a business brings in before any costs are deducted. Revenue is often referred to as the top line because it appears at the top of an income statement. For instance, if a cafe sells 1,000 cups of coffee at £3 each, its revenue would be £3,000. The higher the sales volume or the price of goods, the greater the revenue. However, revenue alone doesn't indicate profitability, as it doesn't account for the costs of running the business. Costs are the expenses that a business incurs to operate, and they are typically categorized into fixed and variable costs. Fixed costs are those that do not change with the level of production or sales. These include expenses such as rent, salaries, insurance, and utility bills. For example, whether a manufacturing plant produces 1,000 units or 10,000 units, the rent for the factory remains the same. Fixed costs are predictable and help businesses plan their financial obligations, but they also represent ongoing financial commitments that must be met regardless of business performance. Variable costs, on the other hand, fluctuate with the level of production or sales. These costs include raw materials, direct labor, and packaging. For example, if a company produces shoes, the cost of leather, stitching, and assembly labor will increase as more shoes are produced. The more a business produces, the higher its variable costs will be. Managing variable costs effectively is crucial for maintaining profitability, especially as production scales up. A key concept that helps businesses understand the relationship between their costs and production is the average unit cost. This is calculated by dividing the total cost, both fixed and variable, by the number of units produced. The average unit cost helps businesses determine how much it costs to produce each item on average and is a useful measure for setting prices. For example, if a company incurs £10,000 in total costs to produce 1,000 units, the average unit cost would be £10 per unit. By understanding this figure, the business can set its prices higher than the average unit cost to ensure profitability. If the business sets a price lower than the average unit cost, it will incur losses. Profit is what remains after all costs are deducted from revenue. If a business earns more revenue than it spends on costs, it makes a profit. Profit is the ultimate goal for most businesses, as it allows for growth, reinvestment, and providing returns to owners or shareholders. There are two types of profit to consider: gross profit and net profit. Gross profit is calculated by subtracting the cost of goods sold, direct variable costs, from revenue. Net profit is what remains after all expenses, including both fixed and variable costs, are deducted from revenue. For example, consider a bakery that generates £50,000 in revenue from cake sales. If the cost of ingredients, labor, and packaging, variable costs, is £20,000, the bakery's gross profit would be £30,000. However, the bakery also needs to pay fixed costs such as rent, insurance, and salaries totaling £15,000. After deducting these fixed costs from the gross profit, the net profit would be £15,000. This net profit indicates the bakery's overall profitability after accounting for all costs. If a business's costs exceed its revenue, it incurs a loss. For example, if the bakery from the previous example had total costs of £55,000 but only generated £50,000 in revenue, it would lose £5,000. Consistent losses over time can lead to financial difficulties and, in severe cases, business failure. This is why it's essential for businesses to monitor both their revenue and costs closely, ensuring that revenue consistently exceeds costs to maintain profitability. In conclusion, revenue, costs, and profit are interconnected aspects of business finance. Revenue is the money a business earns from its activities, while costs represent the expenditures necessary to run the business, including fixed and variable costs. Profit is achieved when revenue exceeds costs, and managing these elements effectively is critical to the long-term success of any business. Understanding how they relate helps businesses make informed decisions, set appropriate prices, and determine the viability of their operations.